The second situation for which we might need a memo is for drawings of assets other than cash. Because they're separate entities, the business and the owner can engage in transactions with each other. So we've dealt with capital contributions, but now we're going to look at the situation where we've got the entity over here, which is the owner, does not equal the entity, which is the business. And they'll both have assets, but we're going to look at the situation where the business has assets like money, cars, or property, and the owner takes them out. We call that drawings, when the owner is withdrawing their equity or withdrawing their capital from the business. And when the owner withdraws cash from the business, there's already a source document for that, and we've dealt with that quite a bit. So that would be under the cash paid category. Got drawings of cash, and the source document could be either a check card, FPOS, or ATM receipt, depends on how the money was taken out. And then we can also verify that with the bank statement. But what about when the owner withdraws an asset other than cash, like a car, property, laptop, or maybe even inventory? How do we treat that? Well, we'll have a look at an example in the next video, but for now what we'll say is it doesn't matter what type of asset the owner can take from the business, they can take anything. It is still classified as drawings, which will decrease the owner's capital. For example, let's say the owner made drawings of inventory costing $1,000. We'll process this in the next video, but for now we'll just say, look, that will be a debit to a ledger called to drawings, which is a negative owner's equity, and it would be a credit to a ledger called inventory. So we can say we've got drawings going up on the debit side and inventory going down. It's an asset and we've got a credit. That's how we do it. What we don't do is this. Why don't we just go to capital and do a debit there? Because that would decrease capital. Keep inventory the same. Inventory is the same, except for we can see the reference is different here because we've used a different ledger. Why is this one on the left the correct one and this one on the right the wrong one? Well, we don't want to do a debit to capital, and the reason is because we want to keep them separate rather than as a debit to capital. We want to have a separate ledger just for drawings, and that's so we can see how much drawings decrease capital this period. So let's take an example. Let's say there's a business that had capital at the start of the period, plus capital contributions of 50, minus drawings of $40,000. Well, we've got a section in our balance sheet here. We've got our asset side and our liabilities would be up above, but we're just looking at the owner's equity section. And we can see sort of a bit of a story here. Capital of 100,000 at the start, gave the business 50, took out 40, and we're going to finish with capital of 110,000. We've got a story there and we can see really important information. The alternative would be if we just did debits to capital whenever we made drawings, we'd just see this. It would be buried. We couldn't see it. We just see capital at the start, capital at the end. Well, that doesn't really work. We need better information. And the reason why we do that is to go back to our accounting theory. This is the correct way to do it. Separate ledger for drawings because it's relevant. We can see the amount of drawings, which means we can make effective decisions. You might look at this and say, that's too many drawings. Capital, basically everything we gave the business is wiped out by drawings. Let's change things. So it's good for decision making. Secondly, it also fulfills the accounting entity assumption because we can literally see all the transactions between the owner and the business.